We will resume with our second and last session, which will cover enterprise risk management. And our topic will be covered by Mr. Vasilis Katsipis. I hope I got that right. Yeah. And Mr. Adnan Abu Haija'a from Arab Orient Insurance will head this session.
Good afternoon. Our next session is about enterprise risk management. Our speaker will give us a forward look into enterprise risk management from rating agency perspective, enterprise risk management and business strategy and investment, enterprise risk management and retention and profitability. Our speaker is Mr. Vasilis Katsipis. Vasilis is based in Dubai and General Manager Market Development of AM Best for MENA and South Central Asia. He has been with AM Best for the last 10 years, having joined the company in London as Managing Senior Financial Analyst and growing to position of General Manager Analytics for EMEA. He has written several pieces focusing on insurance and regulation in Europe and MENA region, and has participated in international bodies focused on establishing global standards for insurance. Prior to joining AM Best, Vasilis was responsible for alternative distribution channels for GE Insurance Solution. He has over 20 years of insurance and reinsurance experience, having focused on both life and non-life sectors. He has held roles in high-level operational and strategic positions. For most of his career, he has held international positions in either Europe or global responsibilities. Vasilis holds an MBA from University of Wales and BSc in Economics from Beirut University. Ladies and gentlemen, joining me in welcoming Mr. Vasilis.
Thank you. And thank you for the organizers to invite me to speak on ERM, a very important and boring subject. I mean, let's face it, when we are talking about ERM, not many people get very excited. And I think my presentation will try, but will fail to make it any more exciting. But I thought of speaking in terms of ERM. Many people feel that ERM is something that actually is imposed by external agencies. It could be rating agencies, it could be the regulators, it could be anybody else, but not business needs. And what I'm trying to do is to see exactly, is ERM any good? Does it add value to the company? And if it adds value, how can it add value? So that's exactly the topic that I'm going to cover today. This is our normal disclaimer. And these are the topics that I'm going to cover today. First, our perspective is that of a rating agency. I represent AM Best, which is a rating agency focusing exclusively on the insurance market. So I'm going to show you how we perceive ERM, and that will set the scene. But later on, we are going to go into more specifics about what's happening in the market. So, without further ado, let's see how we view ERM, and our perspective is not very different to the perspective of other rating agencies. So don't think that this is AM Best and everybody else is something different. So how do we view ERM? This shows you how we generally rate a company. We look at 5 areas. The first one is the balance sheet strength, how much capital they have versus the liabilities and the risks they undertake. And then we look at operating performance, which looks at the profitability of the company and what are the main streams of the profitability. Then we look at the business profile, the position that the company has in the market and how they achieve that position, how they retain and retain profitable business. And then over all of these, we look at ERM. And then country risk. ERM and country risk are things that actually apply to more than one of the activities of the company. It doesn't focus on just one. And that's exactly what I want to show you today. We are, just very quickly say that we are changing the way that we apply our methodology. The building blocks will remain the same, but the way that we use these blocks will change so that it makes it slightly more transparent. What I would like to show you here is that there is one building block. You will see there are three blocks that are put together, which are impacted by country risk, and these are the main core of the analysis: the balance sheet strength, the operating performance, and the business profile. But the next one, the one just outside the grey box, is enterprise risk management. And what that says, I know the letters are very small, but it says that if you have good ERM, you can improve your rating by 1 notch. And if you're really bad for what you're doing, you can reduce your rating by 4 notches. That's because ERM has the ability to destroy a lot of your value, as we will see. So this is one of my favorite games. Actually, it seems to me it's one of the favorite games of everybody in the market. Everybody tries to guess, if so-and-so company has this rating, then I should be better. Yeah? So let's say we have 3 companies, and each one of them has exactly the same capital, 100 million. But then companies A and C make double the profit, 10 million versus 5, and they write 150 million of premium versus 120. So company B has less profit and less premium. Based on that, would you think that probably companies A and C have the highest rating? Yeah? Do we agree? Hands up who agrees with me. Only one person. Okay, good. When we look one step further, we find actually the middle company, which makes less profit, has lower combined ratio. That starts getting more interesting, because where do the other ones make their money? Probably they make it out of investments. And then if we look at the history of these companies, we find that actually the one that has the less profit has been making profit forever, whereas the other ones have, the first one has been more patchy. They made profit only once in the last 5 years. So it starts becoming more difficult to figure out which one of these companies would have the highest rating. And then if we look at their capitalization, maybe middle one has an excellent capitalization and the other ones are falling behind. The reason I'm putting this as an example is that, first of all, it's very difficult from the outside to figure what the rating of the company will be. And secondly, we don't know what the risk appetite of these companies are, which actually comes to translate into we don't know if these numbers are good or bad. Maybe company A, which may look not as good as the others, that's exactly their business model, and they are set up to operate like that. And in that respect, maybe they deserve a higher rating. So, what is ERM? ERM, you can see it in everything the company does. It's not just in one area. It looks into the capitalization. It looks into the operating performance. It links with the business position of the company. All of these things are linked and influenced by ERM. Because ERM is a process that helps insurers and reinsurers to identify and quantify the risks that they are facing for the whole company. It's not just for underwriting, but it links all of the departments and the activities of the company. So it's enterprise-wise. That's what the point is, and the difference from simple risk management. And it takes into consideration the individual risks, but then it looks at the correlations. If we do this in our underwriting, how does that impact our investments and vice versa? Does it impact it? Is there any correlation? Could it be that we have a big risk here which is correlated with another risk elsewhere? That's the importance of what ERM is doing. So, in an ideal scenario, we should be able to look into an insurance and reinsurance company and put it into one of 4 buckets based on their risk appetite. Do they take a lot of risk? Do they want to take a lot of risk or little? And how do we do that? By looking at everything that the company does. We can look into the type of business that they're writing. We can look at the market profile. We can look at their capitalization, their investments and their liquidity. And when we do that, we should be able to put the company into one of these 4 buckets. And if a company has a high risk profile, we would expect that company to have good capabilities. So if we look at the company's risk profile on one side and their ERM capabilities on the other, a company with high risk should have superior ERM capabilities. To put it into a day-to-day practice, if you want to drive like a racing driver, you should be a racing driver, and probably you should drive a very good car. Equally, if you have minimal risk, you don't need to have too great ERM capabilities. So if you want to drive very slowly and carefully to work, you don't need all the abilities that the racing driver needs. So in the rating process, if you are taking minimal risk, so your risk profile is much lower than what your abilities are, which is what we are showing here, then you will have a higher rating. Equally, if you are taking a lot of risk and you don't have the capabilities, then you will have a lower rating. Simple enough. And as I said, in an ideal scenario, you match your risk profile with your capabilities. And to finish with what we do as a rating agency, we have our own capital model. What that one shows you is that there is, for every rating, there is a minimum capitalization you need to have. And it says that if you have a good ERM, your capitalization will improve over time much faster than if you have a weak one. And therefore your rating will go higher much faster than if you have a weak ERM. So enough about what we do and how we view ERM. Let's look into what's happening in the market. Quite often we hear a lot of things repeated again and again. These are statements that we've heard several times in the market. I think the 2 that I would like to focus today are, number 1, the top right corner. ERM is good for developed markets, but it doesn't apply here. And linked with that, the other one on the bottom left corner, if we were to apply ERM, we wouldn't make profit because it's too expensive and we would never, it will eat up all our margins. So I am trying to show here that neither of these statements are true. Let's start. Let's look how ERM can help shape a profitable business strategy. Remember we talked about risk profile. This is how we view the risk profile based on different lines of business. And you will see that I have put a red border around different risk profiles, because that border shows where we think the Middle East markets are. In terms of lines of business, we think that the market is focused more on low-risk business, and that's because typically we have short-tail business, and motor and medical are mainly the business that actually dominate the insurance portfolios, especially the retained portfolios. In terms of the policy limits, we have different levels, and we think that the policy limits that we see in the MENA region are mainly medium risk, and I would go on and say that probably on a retained basis it's low. And finally, in terms of correlation, again, there is medium risk. Companies argue that it's low, but to have a low risk environment, it will mean that you have negative correlations between your product lines, and we don't have that here. Yeah? So broadly speaking, in terms of lines of business, it's somewhere around medium risk. In terms of the growth that we see in the market and the concentration, we don't see any major concentrations. However, the growth is coming out of small changes in existing products, and that is more medium risk. And there are also occasional changes in the product coverage and the descriptions, and again, that is less than completely stable. So all in all, this is how we would see the market. In terms of the business profile of the market, it's around medium risk. Let's go and see what's happening in the markets. This shows you the growth of the MENA markets over the last 10 years. And what you can see is the top two countries that have been dominating in terms of growth, that's Saudi Arabia and the UAE. These are the largest markets in the region. These, and the third one that has been showing some growth is Qatar, which is much lower. All the other national markets have been relatively stable. And if you want to go into why the growth has happened in this market, it has to do to a great extent through the introduction of compulsory covers. And how can we see that? By the mere fact that insurance penetration has not really moved that much faster than the growth of GDP. But then if you look a little bit further, that's exactly what we see here. This shows you the growth out of motor and medical lines of business. So we have, you can see that the motor and medical are the two lines that have been growing much faster than anything else. You can see at the bottom of the chart, there is a dotted line. That is the average growth for all the markets. If you put them all together, that's what the markets have done, the MENA markets. They have remained relatively stable. So all the growth has come out of motor and medical. That is compulsory covers, and that's increases on premiums. That's where the growth of the market has come. Now, this is what the market as a whole has been doing. The problem is the majority of the companies have been doing exactly the same. All of the companies have been focusing on all of the product lines and all of the segments. A few exceptions exist. This is a snapshot, if you wish, over the last 10 years for the Saudi market. Most of you know that in the Saudi market we have three large insurers, Tawuniya, Bupa, and MedGulf. And then we have the next 7 companies and everybody else. So this shows you the premium growth of the different segments. The green are Tawuniya and MedGulf. And you can see that the market share has been coming down. The blue is Bupa. And what you can see here is Bupa has increased their market share in the space of a few years from 10% to 20%. There is also another company that I'm picking here, and that is Allianz, which is the orange line. It's running along the bottom. It has a stable market share of about 3%. If you see at all the other segments, which is the gray lines, they have been either stable or declining. So Bupa, which has been focusing purely on one product line, medical, and Allianz, which has been focusing on one segment, SMEs, are the two that I'm picking out. Bupa, you can see the success in terms of market share. But it's interesting when you go to the next slide, which shows the profitability of the market. And you can see that the blue bar, which shows Bupa, is one of the two companies that has been consistently making profits in all of the years that we are looking at. And the other company that has been consistently making profits over the last 6 years is Allianz. Interestingly, these are the only two companies that have a focused marketing strategy, either on a product or on a segment. Every other company in the market has had 1 or more years of significant losses. And the reason that these companies are able to do that is because A, they have different ERM capabilities, and B, they're using them. So it requires different skills to focus on just one product line. It requires different from the skills that are required when you're running several lines for one segment. You have higher correlations in both cases than you would have in a company that writes all lines of business. And one of the reasons that these specific companies can make that is exactly because they are obviously getting expertise from their parents. But in both cases, it shows that a differentiated strategy with the relevant ERM capabilities pays better in terms of profitability than the rest of the market. And if you think that you need to be a subsidiary of a large international insurer, think again. This is a snapshot of the Bahraini market. The beige line is the total premiums, the beige area. And then the yellow one below it is the life premiums. So, life premiums is about 20% of the total market. And in all that, there is the blue area, which is LIC. It's a subsidiary of LIC of India. They write 30% of the life premiums in Bahrain, 30% of 20%, about 6%. The green line shows that how much of the total market profit they accumulate. By writing 6% of the market premium, they write between 15 and 20% of the profit in the market. A lot to be said about a differentiated strategy. And in all cases, different ERM capabilities in order to do it successfully. ERM and focus on investments. Typically, the market is characterized by a lot of risk on the investments. We have a lot of tendency to invest in real estate and equities in the markets, which impact the liquidity. So we have, in many cases, highly illiquid investments. That has its problems, and as we will see, it's not necessarily a positive in the market. Summarizing into investments, we think that the market is taking high risk, and to do that, it needs high ERM capabilities. This is, again, a description of the market based on the investment strategies that the different companies are following. By the way, all these data slides, they're based on our own proprietary data. We've analyzed about 400 companies over 10 years to come up with that. So what you can see is there are investments which we consider less risky, and I painted them green, different shades of green, and others which are more risky, and there are different shades of orange. So you can see that as the years go by, the good investment strategies have increased. We have seen more and more companies focusing their investment strategies either on cash or on balanced strategies. Balanced are the ones in the middle. We're also seeing in the recent years an increase in the dark brown at the top, which had reduced and now it's increasing again. And that is investments focused on shares, and also the yellow and the orange, which are real estate and other investments. Please take into account that the way real estate is accounted in several markets and in several companies is questionable. So probably we're underestimating this. Yeah? So that's what's been happening in terms of the investments. Now, in reality, you put more risky investments, you should have higher returns, yes? Let's see what's been happening. This is the yield out of the investments. The top one is investments focused on, strategies focused on bonds. The bottom one, the purple, which was negative in 2008, is real estate. So on that one, the only thing we can say is that insurance companies that focus their investments on bonds, they made better return. But hold on, that's not high risk. Is that reality? And if you try to untangle this spaghetti in the middle, it's very difficult, because some moves up and some moves down. But if we look at it as a performance over 10 years, you can see that bonds have returned the highest yield in the investment portfolios, followed by balanced strategies, followed by cash. So companies that have been taking extra risk out of real estate and equities have not had the yields. Is that a good investment? And one step further, if that is a good investment or a bad, how does that link with a company's ERM appetite, risk appetite, and do the companies actually have the high skills that they need in order to identify the risks and the correlations between these investments and what they're doing? So, for example, if you're writing property and you're investing in property, have you ever identified what the correlation is? I don't know of any company that has done something like that in the region. Final point is looking in terms of retention and profitability in the market. As you know, a lot of the market is focusing on retaining very little. On the positive side, the majority of reinsurers that are operating in this market are the national reinsurers, and therefore the majority of the recoverables are of high quality. And the other positive is obviously the net retained exposure is very low for the companies. So you have an average or medium risk in terms of the recoverables, high risk in terms of ceding too much, and what would happen if your reinsurers are not able to repay you, and low risk because what you're retaining is very little. So overall, somewhere in the middle, medium risk. Look at this. This shows you the combined ratio of the companies based on how much reinsurance they buy. So the blue line shows you the companies that insure a lot, high cession ratios. They cede more than 60% of their business. The green one shows the companies that actually retain a lot. They retain more than 80%. And the others are in the middle. So if you look at this, you say, okay, the companies which reinsure a lot are the more profitable. Yeah? So, however, if you look one step further, you realize that these companies are actually getting a lot of reinsurance commissions. And if you were to actually run them all on the same basis, assume that everybody reinsures the same proportion of their business. The picture changes. And the companies which actually reinsure a lot have the highest combined ratio. Yeah? Actually, for most of the years, they have combined ratio above 100%. And the companies that retain the most are the most profitable. So what we have is we have reinsurance helping to improve the profitability of the not so good companies in the market. And if you go one step further, you look at how much that reinsurance is costing the companies. Here we're looking at reinsurance premiums over reinsured reserves. And you will see that if we could have on a rate online, it would seem like this. It would seem that the companies which are reinsuring the most actually pay the most per unit of reinsurance. Not only that, the blue line that has been relatively stable and if anything increasing. It's the companies that are not reinsuring a lot that have been benefiting from whatever decline in reinsurance premiums we've seen. And if you, hello. My goodness, we are. So moving on very fast the presentation to get to where we were. The last thing that I'm going to look at is, do these companies reinsure because they need it? And the chart on the left shows you how much capital they have. And you will see that the blue bars, the companies that reinsure a lot, are much higher than anybody else. That's the company's average capital. So, companies which reinsure a lot actually have most capital. And if you look on the other side, on the right, it shows you how much premiums they write. And you will see that the blue line is the lowest one, or one of the lowest. So they have most capital and write least business. So they don't do it because they are short of capital. They do it because they are short of profitability. And I think that is also a problem for the market as a whole, that is supporting bad practices through reinsurance, or reinsurers are supporting bad practices in the market. So, if we put these things together, this is companies looking top to bottom, high levels of reinsurance, therefore high risk, to low levels of reinsurance, and from left to right, low to high level of investments. And you will see that more than 35% of the market, the areas shaded as orange, take a lot of risk both in reinsurance and in their investments. And I think that's critical not only for these specific companies, but also for the viability of the market as a whole. So, enough of me taking all this time on a boring subject. I'll summarize very quickly. ERM is not important for a rating. However, it is important to run a company profitably. It doesn't need to be a massive organization in order to be successful. It has to be in line with your company and your operations. But if you do it right, it adds value. Hopefully that's what I've shown here. And by doing that, you get a higher rating. The rating does not improve your company, it just shows you where you are. Thank you very much for your attention.
Thanks a lot, Vasilis, for your speech. I will start from your conclusion slide. Actually, I have a couple of questions before we send the microphone to our audiences. You mentioned that the ERM is not requirements for rating agencies. Who should be the main driver for stronger enterprise risk management? Regulator, management, board of director, or rating agency? The second question is, How you assess the overall enterprise risk management and maturity in insurance industry across the MENA region?
In terms of the main driver of the ARM, I would say that it has to be the board and the management of the company. It cannot be an external organization, because no external organization is running the company. And it has to be something that the company feels it's necessary to do and finds the value in it. Otherwise, it will always feel like it is forced upon the company. Yeah? In terms of where the market is, I would say on average the market is on a low level of ERM capability. There are very few companies that have been moving a little bit further forward. And I would say, if I look on the whole of MENA, probably somewhere between 5 and 7 companies that are actually starting to realize what E in the ARM is. We have many companies that actually get the risk management, but we don't have that many companies that get the E.
Unfortunately to hear that. Okay. Anyone have any question to Mr. Vasilis? Any questions? Okay. Okay, let's see, I have another question. Okay, Hadi.
Thank you very much, Vasilis, for very interesting presentation as usual. I like your presentation. Being from a rating agency, look from outside our companies, looking at our companies, our markets, giving hints and statistics about what trends the companies they need to adopt into the future. Very informative. I see the comment, your comment on the dominance of our portfolios are medical and motor third-party liability, most probably the compulsory ones. In my view, these classes of business, and your view, I think, is categorized by high cost, technical cost, and administration cost. At the end, it's a cash flow that plays, and how this cash flow can be managed and utilized for investment. If we fail to employ this cash flow into the right investment tools to provide the returns to make up or to increase the profitability from these lines of business, we will fail. Second, the other classes of business categorized by small number of risks, high values, likely to be reinsured, capacity, local capacity or automatic facilities are not enough to increase the retention. And I relate this to your slides comparing market and combined ratios in general, but it has particular considerations relating to each class of business and the number of risks involved and the ability of the company to increase its retention in these classes of business. Because facts of life, treaties, automatic facilities, increase of will not be balanced if the number of risks are not big enough. That's another difficulty challenge for us in the Middle East to increase the retention in certain classes of business. Softness of the market is not becoming a soft and hard market, but it's becoming the market through competition and supply and demand, whether it is the indirect insurance or the reinsurance side. But I see there is a fault in the regulatory requirements for entering in new companies. When we compare capital adequacy, etc., laws are stated like 20 years ago, require minimum capital for a company to set up 5 million. 20 years later, still 5 million. And the new entrants come and take advantage of this and compete, and of course at the beginning will try to acquire share at lower rates and forcing the bigger companies to lower rate. And this is another dilemma challenge. Your comments on these points, I'm sorry if it was lengthy, comments and question raising for the benefit of all of us to benefit. Second, last point, rating companies, I see it's not for the rating, it's for a third party to look at our business and assist us to establish proper management tools to grow. That's my point. Thank you very much.
Okay, touching on the answers on all the very valid points that you mentioned. I agree with you that very few companies can actually, from the point where they are, say, I stop writing motor and medical and I do something else. Because these product lines provide cash flow. However, from the point where companies say 10 years ago they were writing mainly motor, and then they expanded on medical because it was another cash flow, I think that exhibited the naivety in the market. I mean, if you go and write a line of business because it gives you cash flow, and if you get it right, you get a combined of 95, 98, and if you get it wrong, you get a combined of 130. That sounds like a decision you need to think a little bit more and get the skills that are required. Drupa did, others didn't. So it is important that you balance how much motor you're at and medical. On the other hand, companies go and write motor and medical, which are generally short-tail business in this part of the world, and they're backing it with real estate or equities, which even the equities are not liquid. So that to me sounds like you're starting from a valid point, and maybe that's your risk appetite, but have the companies considered these risks? And have they got a get-out clause? What happens if my combined ratio goes above 100 on these lines and I need to sell some of my investments? I don't think there are many companies which have considered it. Yeah? In terms of the barriers to entry and the regulatory minimum capital, I think that's one of the problems that many regulators in the region, regulatory regimes have. Personally, I don't think a minimum capital is the right requirement. I can put a minimum capital at, let's say, 100 million, but if what I want to do is write cat-exposed reinsurance, probably that's too little. So I would encourage the systems to move into a more risk-adjusted capitalization. What you want to do, for what you do, that's the capital you need. And I agree with you fully that these things need to be modernized.
Any more questions? Okay, thank you everybody. Thank you, Mr. Vasilis.
Thank you, Mr. Vasilis and Mr. Adnan. Mr. Adnan, we'd like you to kindly deliver the honoring gift to our second speaker, Mr. Vasilis, please. On a small note, we'd like to announce that all the presentations for today will be uploaded on the website, so you can upload it from there. We'd like to inform you that for tonight's dinner party at Isla Oasis, the Federation will be providing transportation by boats for those who are interested in using this means of transportation and enjoy half an hour sea tour and sunset view. The boats will be sailing from the Intercontinental Jetty at 6:30. As for the guests that are staying in Kempinski, the boats will be sailing from their hotel Jetty at 6:30 as well. For all the guests that are staying in other hotels, they're kindly requested to be ready by 6 p.m. in front of their hotels for the Federation buses to pick them up to the Intercontinental Hotel Beach. For guests who prefer to go to the party by shuttles, the Federation buses will be picking them up from their hotels at 7:30. So if any one of you is interested, please refer back to the information desk in front of the main conference hall for registration. Now we'd like to ask Mr. Majid Smirat to come to the stage one more time to deliver an honoring gift to Mr. Adnan. We'd like to move to the last part of today's session. Mr. Fadhel Sabea, FCII Senior Manager in Hannover Rueck, will head this panel discussion, which will include Mr. Zaccar, President of GAIF, Mr. Hatem Ismail, Managing Director of Crawford, Jordan, and Mr. Peter Englund, Senior Executive Officer. Please welcome them to the stage.
Hello, good afternoon, ladies and gentlemen. My name is Fadhel Sabea, and I'm from Hannover Rueck. Since we're the only thing standing between you and lunch, we'll try to be as quick as possible. At the outset, I would like to thank the organizing committee for giving me the opportunity to be here, and the Jordan Insurance Federation as well for making this conference a success. Without further ado, let me just introduce very quickly our distinguished panel. Mr. Zaccar, President of the GAIF, and President of the AQAL, and the Chairman of Commercial Insurance at Lebanon. Mr. Peter Englund, Senior Executive Officer, Commercial Lines, Zurich, Dubai. And my dear friend, Mr. Hatem Ismail, MD, Crawford. This is an open panel discussion, so what we're going to do is basically touch base on the main topics that were discussed during the past couple of days, namely PV, cyber insurance, ERM, and marine claims. And we'll start with each of these topics, and I'll give the opportunity, the floor to the panel to elaborate a little bit and to remark. And then we'll give the floor to the audience to ask their questions. PV and terrorism. Mr. Zaccar.
Yes, first of all, is it possible to have, because we we can't even hear ourselves in the panel. Regarding PV, political violence, I think we are living with violence, and the main thing is we are granting these coverages with a lot of different coverages, with a lot of different clauses. But in fact, at the end of the day, it must be to the government to declare whether it is a terrorist act or not. And this is the most important thing, I think, in our business, because otherwise we can remain talking about the clauses, and in the past we had many instances where they were talking and saying, well, political violence, it should be at least 3 persons, armed or not armed, and so on. So I believe that our governments must declare clearly when it is political violence or not. Thank you.
Peter? Could somebody please check the mic?
It's on. Good afternoon, everyone, and it's great to be here in Aqaba. A couple of words on cyber then. I think I would like to approach it in 2 ways. First, it's the exposure itself. I think we've seen many good examples during the last period of time of how severe and how real this threat is. Now with the recent global outbreak, we've also had 2, as you may be aware, 2 major outbreaks here in just recently in Saudi Arabia, another version of this Shamoon virus. So this also applies to the discussion on enterprise risk management and how we as institutions need to approach this subject. As an insurer, and I need to stress here, just to add some context, that I represent Zurich. We operate as a facultative reinsurer. I think is a valid comment with all the great sort of takeaways from Vasilis' presentation, but again, speaking mainly then on the direct side. Cyber, we've seen the cover, the products or the proposition somewhat evolve from professional liability, third-party product, to now standalone first-party protection, in addition to these also the third-party or the professional liability products already in place, of course. If we take the benefits for insurers with the new digital reality, of course, comes down to an increased profitability. We see. I believe the industry has an expense issue overall, and sort of an increased element of robotics, automation can actually make us perform better and become even more profitable. And it becomes even more important as well as we operate these days in a lower interest rate environment. So that's really the benefit, and that's clearly something that we look to exploit. The proposition has evolved, as I said, and what are the challenges? For insurers who've sort of entered this space, I believe it's fair to say that pricing is one of the challenges. The exposure is of a low frequency, high severity kind. Hence, there is little data available for the kind of losses that we may come across. Another challenge is, of course, having the right skilled underwriters on board, not only who understands the current exposure, but also who are on top of the trends going forward. So that's how I would like to summarize the cyber bit.
Your views from a loss adjusting perspective on the subject.
There you go.
Can you? Working? Okay. I'm going to talk about this cyber liability issue from a loss adjuster point of view. I think you all agree it's a new technology with a continuous development every day. And this is always, as there is a development in the security and the protection of this data for any companies, there is also a counter penetration, development in the penetration by hackers and the rest from the other side. And I'm sure you heard that most of the highest organization, even the Pentagon, has been penetrated. So there is no limit, practically, of the possibility of people penetrating this data. The problem with this kind of cover, that it's not sometimes easy to establish the material damage which actually has been inflicted on the company and or on the insured. And also here, the scope of covers might open, that will give them an open field, because some of the items which are involved here, it's not like when you're having a fire damage where you quantify how much is the building damage, how much is the stock damage. Here you are quantifying data, not something which you can touchable or materialize to count or verify. I think this is one danger of this sort of cover. More importantly, from our experience through the 30 years, of course, we have seen what we call the fraud cases or deliberate fires or that. This sort of thing is easy to identify in fire claims or in other kind of claims. But in this one, let me give you a just simple example. Here I have a company called X. I will go and hire hackers to attack the company temporarily. I'm very careful about the word temporary. He will raise the claim to the insurance company. He will say, yes, this is my losses, this is what I am, this is what I have suffered. Then after he gets his money, he goes back to the hackers and they say, thank you very much, get back all the information back into my system. So this sort of thing, it's expected to happen. I could imagine it happening in such coverage of these cases. And also there is another aspect in the ransom. I'm sure all of you heard just about a few weeks ago, some of the organizations had been attacked. They would ask for ransoms. Now, hackers, I'm sure somehow they will be able to get the information how much the insurance company is likely to pay if this intervention or penetration of this company lasts, if it lasts for a year or 6 months or 7 months. So if they were going to ask for a ransom, and especially if they know there is an insurance company involved, I can tell you from now, the ransom will be doubled, if it's not tripled, okay? So this is another issue regarding this kind of coverage. We are getting to a lot of unknown factors. It's a new field with unknown factors involved. More importantly, if you look at the cover, they are saying the insurance will be paying for repair of the company reputation, repair of the, for repair for the individual reputation. You will pay for the forensic expenses and that. So there is going to be a lot of expenses incurred by reinsurers from different aspects. Actually, the way I see it, the most party will be involved is IT people. This is, I think, where the thing will lie on. So in a way, insurance will be faced with very high expenses for a professional advice. They will be faced with a fraudulent claim, or let's say cooked claim, let's use that expression, okay, which is easy to do in this sort of system of data than doing it in fires or in other kinds of coverage you might find it in the business. And also, here we have also, and I can see that the cover sometimes open a third party cover also. I mean, that's another headache. Everybody wants to go to chop into the bot, as they say it. Everybody, as soon as they hear there's something wrong, they will even try to make money out of an incident which occurred in one company or another, or the insured data. So what I'm saying, just put it shortly, this is not an easy cover. This is an open field, all right, where there's a lot of unknown factors, which I think, in the end of the day, in any claims, insurance might end up paying a high amount of money in such a claims. And this is whether the payment will be regarding data or the payment will be regarding professional fees going to be requested and involved in this case. So what I said, from my experience, the best way out of Such a situation usually is just to put a sub-limit for each and every item of coverage. I think by this way you have limited what we call it somebody dancing in the clay. Okay? I think this is the only way I can see from a loss adjuster point of view, it's just to have a limit regarding every cover of every aspect of cover or scope of cover given under the policy. Thank you very much indeed.
Regarding cyber attack, clearly it is a new coverage, and we all know that 85% of the premium are being written in America. And we are all waiting for court cases to be able to find out how the claims are being handled. I believe there are two sorts of claims. You have the material damage claim, which is quite easy, how to bring back your computer in the right state, how to have the documentations again in your computer. So this is easy, of course. It will be very much difficult to have the damages caused by reputation, loss of data, but in a way you can have banks which go bankrupt if they lose the data of their clients. Considering this, we would like to know from the audience how many inquiries you have received on cyber attack. This might be a good sign regarding what is going on in the Middle East. Anybody who has been approached for cyber attack, cyber insurance?
Could we get the microphone, please? Over there.
I think imminently we shall receive requests for cyber insurance. As a company trust, we have received several. The problem is that we don't have automatic facilities. We have to go to the market and provide the information, and even providing the information is not as easy because we don't have the expertise in-house. Also the companies, the clients don't have the knowledge and the full awareness of what is needed to provide and even document it so that it can be presented in a proper way so that they can get the support. So we shall be acting as brokers, as intermediaries, as insurance companies in the Middle East, liaising between clients and reinsurers based on requirements. In my view, like terrorism, like sabotage and terrorism, the question with the new coverages, the lack of previous experience and data, what can be the future experience going to be? It may be costly to go through this experience. That's why there is a deterrence for some companies to promote proactively the marketing of these covers. And I noted Hatem's comment about the moral hazard involved, collaboration between insured and hackers to manipulate some money from insurance companies or from clients and then insurance companies. Thank you.
Thank you. Anybody else have questions?
Just a quick side, and again going back to Vasilis' presentation earlier, and looking at the region, we can conclude in some segments there is a dependency on, say, motor and medical, but we also see in certain markets, say Saudi Arabia, there's also a push for a more diverse insurance portfolio, and cyber could be one of these emerging products that we see in terms of business opportunity. Again, and as you alluded to, it also calls for a good risk management function and making sure that we have the capabilities to take on these kind of risks.
Yes, Peter, I agree. I mean, the region, if you look at, for example, Saudi Arabia, 83% of the market premium is motor and medical. And that's 83% of $10 billion. So yes, a lot of companies still adopt the cash flow underwriting model, and they rely heavily on the investment market, their investment portfolio, to cover up their underwriting deficit. It has worked perfectly in the past, but now when companies had to come back to basics and produce a technical underwriting profit, companies are struggling, and some companies we've seen in many markets have disappeared. I've got a comment here that we've learned from yesterday. We've learned that cyber insurance is a highly reactive insurance product. Yeah, i.e. a product which needs to be customized quickly, creatively, due to the mutability of cyber threats act, whether it's coverages, inclusions, exclusions, or services. So how do you see that?
It goes maybe back to my comments there about one of the challenges. As I said, it's an exposure which is in some ways moving constantly. It's constantly developing, so it calls for a lot of product development, making sure that you have suitable products in place for your customers, and also a framework in terms of potentially third-party administrators who can really take on and service these claims. So I guess that, in that sense, yes. But again, it's just calls for innovation and making sure that we're accurate and on top of these developments to really make sure that we can have a suitable proposition in place.
Okay.
I think we should not be. We should consider the situation as it is. Something that is very important is that we as insurer have to put the standard regarding the insurance of cyber. It's not just saying, well, cyber, do you have cyber? We'll sell you a cyber insurance. We are going to put norms, we are going to ask for a questionnaire, we are going to be more technical, and you must all imagine that cyber insurance in the future will represent 25% of the worldwide premium. Let's not forget that. You want it or not, we will have a tax on factories, on motor car, on houses, etc., etc. So cyber insurance will be something that will be probably added in all insurance policies. And probably clients who are working with banks will make sure that the banks have a cyber insurance cover in place. So we as insurer, we have the duty to establish the norms and to impose those norms to our future clients. Thank you.
Thank you, Mr. Zaccar. Hatem?
Yeah, okay. There is something, another issue I think which we need to look at in the long run, how the courts are going to deal with cases of this nature if it goes to court. I mean, through the years, and most of you have probably heard or experienced, sometimes it's difficult for the insurance company to get the pictures clear in a court case regarding simple cases of fire or damage to contract works, etc., etc. Now here, I think somebody has to look onto that aspect, how this is going to be dealt with it if it goes to court. Would it be, we see sometimes in courts, in similar cases, they will appoint an expert, let's say, to assess the damages to the building or that. Now here you are getting into a different technology. It's a new developed technology. Probably the court will not be able to find a qualified expert within the region or the country who will be able to give a good picture of exactly what happened. So this is also another aspect I think it needs to be considered, that if such cases end up in courts can be managed, is it possible for the courts to be able to obtain what's really going on and the factors involved? Now the other issue is the wording of the policy. Now, is the wordings are so clear so the court can take it that there's no ambiguous wording which can be translated to different meanings or possibilities. So I think this issue also I think has to be considered when regarding providing this kind of cover for the cyber attack, because as you know, sometimes it's not easy for the courts to understand what the policy talks about, and more importantly, we are getting into a new technology. Not many people are professional in it, and they have enough knowledge even to explain to how this system works, or how the loss happened, or if there is a loss or there's no loss, or whatever. So I think that's another aspect which is somebody has to really think it over regarding this cyber thing.
Yes, you are very right, but who would think 15 years ago that we would have a small telephone, mobile phone, and that we would call from anywhere in the world? We cannot go against technology. Technology is there. The courts will be specialized. And again, I would say that 25% of the worldwide premium will be on cyber. So we have to be ready for this. I think a judge is not going to go into the details of software or hardware. He will appoint a specialist, as you would do as a surveyor, and based on the conclusion of the specialist, he will have to judge whether there is a claim or not. So we cannot go against technology, and we have to get ready for the 25% premium that we are going to write in the future.
Zaccar, thank you. Any other questions from the audience? If you have a question, please raise your hand. No questions? Should we break for lunch? Okay. We will cover the remaining topics, which are the ERM and the marine claims, and I'll give the floor to the panel to remark on these topics. Mr. Zaccar?
Yes, for marine, I was not very comfortable with what was said. It means that we are going to pay small claims, and when there will be a big one, we are going to go to court, or we are going to make pressure to our clients. And I believe that at the end of the day, the brokers or the clients will ask that we sign a statement that we have got all the information that we want to pay any claims. So I wonder in the audience if somebody has an idea or suggestion regarding marine claims.
No questions? Hatem, would you like to comment?
So let's hope that we're not going to use, actually all our insurance policies for marine, all our insurance clauses are as per English law and practice. So even if we go to court and there is a local legislation, the local legislation is going to base itself on the English law and the English law and practice. So it's not that there is a Jordanian law or Lebanese law. The Jordanian law will look into the insurance policy, insurance conditions, and will base its judgment on the English law and practice. I don't know if somebody else has something different of what I'm saying.
Maybe just a couple of, going back to enterprise risk management for a moment. I think another thing worth observing is as we see new kind of threats like cyber, or as the region move away to a certain extent from oil dependency, I think it calls for an even greater importance on having a sound sort of risk management function and ERM setup in your business. For us, I think we see a growing dependence on less oil-dependent countries. We see a stronger focus on Africa going forward. And as we approach both these new exposures but also new markets, it's imperative for us to have a good discussion within the management team and within our chief risk officer on how to address these opportunities.
Thank you. Mr. Zaccar, ERM, over to you. How do you see ERM? What is the value proposition of ERM? And whose responsibility to take care of ERM?
Well, after the excellent presentation of Vasilis of AM Best, I can only give my point of view regarding being an insurer. So if you allow me, I will read you what I have prepared, and you stop me if you think it's too long. ERM should now be at the level of the board of directors of any company after the implementation of corporate governance, which is in essence consists of an audit committee which is checking mostly that the accounts are in good order, a nominating committee which proposes the names of future board members, a succession committee which makes sure that top positions are being taken care of, a compensation committee analyzing the income of top employees, all the above within the framework of board members' undertaking. So this was the corporate governance that we all know about. We have now to ask ourselves the following questions. The chairman must be the personality that will provide the best image of the company. He must not necessarily know about the insurance and must not be involved in the day-to-day business. The other board members can come with the industry, within the industry, but again, because they only meet from time to time, they can only draw with the chairman and the general policy of the company. So this is the role of the board. So what should be also the role of an independent board member? Presently, the CEO is in charge of applying the recommendations of the board. In this respect, how much does the board and the CEO know about the day-to-day operations? For the last few years, the insurance industry has been confronted with the challenges of ridiculous competition to increase market shares in all lines of business. Despite the overall market losses, this competition continues to increase. The very small returns on financial investments, especially in the Gulf area, where unfortunately a lot of time we have mercenaries in the position of CEO, of managing directors. Certainly by applying the wise risk management, which means accepting to compete on clean business after deep analysis of the risk and implementation by the client of pre-risk recommendations. But this meant that the board shareholder, CEO, accepted the potential reduction of to reduce the turnover. There comes the role of enterprise risk management, which involves the board as well as the CEO to full and deeper understanding and how risk is being managed across the company. Meaning that we are moving from a management to a risk management. Full compliance of the procedure and policy of the company lines up risk appetite and business strategy, embeds risk management in all processes of the company and involve all the personnel, which must also be reassured about their future, improve the communication between the different departments of the company and advertise the benefits of such policy on the company's result. So this is ERM. In my view, we will see very soon the emergence of an ERM new committee, which will involve the CEO as well as the board in the day-to-day operation, that will probably be imposed by insurance regulators as part of corporate governance. Actually, regulators are imposing corporate governance. In my view, the insurance regulation will impose ERM. But here there is a question that one must ask, and I am asking it to you. With all the companies which are growing and growing and growing, shall we continue seeing that insurance companies are too big to fall? We have seen insurance companies which were very big and they fell. So what should be also the future of our insurance companies, or in fact all industries? Are we going to dismantle the big companies to be able to follow out on enterprise risk management? That is a question that we will see in the future, the answer.
Thank you, Mr. Zaccar. Peter, how do you see ERM from an international perspective?
It's clearly a necessity. It's something. Yeah, it's an that is linked to the business strategy and is needed in order for us to achieve our goals. I have personally, I have a chief risk officer on my management team who. And really, this is how we I think it's comments and it's around us. I spent a week in Saudi Arabia last week when it was more or less encouraged by the regulator for companies to consolidate in order to take on the new sort of regulatory pressure and really the topics we discuss. So I think that gives us an idea, perhaps in certain markets, what sort of the new reality may look like when it comes to enterprise risk management.
Thank you, Peter. Could we have the microphone over there, please? Mr. Khalid, you can keep the microphone with you, sir.
I'm so sorry if I am a nuisance with my comments.
You're absolutely not. Please.
Okay, thank you very much, Fadhel. Very interesting is risk management presentation today, and I know Vasilis from the past conferences. He's presented very informative, useful to us, but how much of it we take into our companies and apply and do and learn from it. The question of risk management and enterprise risk management or operational risk management, organization risk management, in my view, and I am qualified risk manager, in my view it's not a new, it is embedded in the management of a company, of the companies, of the operations from the beginning, from business management. And who asks this to be implemented, applied, is really embedded in the articles of association of any company. The responsibility of the board of directors for the shareholders and the stakeholders to run the company properly, not to the present, but as a going concern into the future. And hence, what the board capabilities or tools to utilize to deliver this responsibility, call it internal audit, nomination, remuneration, oversight committees of the board, delegation to the executive management to do whatever to be done to implement a approved business plan into the future. Now, with enterprise risk management being a discipline, instead of being taken under responsibility of a CEO of a company or general manager of a company, so it is dedicated person or function within the company reporting to the board of directors of the company, independently from the executive management, to ensure that the company has solid strategies, solid policies, procedures, control system to go into the future with stability. This is in my view. It does not need a regulator, does not need a rating company, it does not need anybody to emphasize the importance of managing our companies. That's in my simple understanding of the risk management and the enterprise risk management. It's part of our duties to go through. One issue and one challenging issue, and we face, this is not what we do internally inside the companies, but the external environment, the environment that we are operating in, what they are doing to enhance the environment so that we are to operate in a proper way into the future. That's a challenge, and this is the issue that we face with regulators, with government bodies, to enhance the external environment, because management of companies don't have any control of, say, the conditions of the market and the influences of the market, growth, economic growth, financial stability, political stability, regional stability, etc. Thank you very much.
Answer? You are so right. You remember me, the way we were managing our companies many years ago. And we have to come back to the same way of managing our companies. Today, we have boards. The boards are supposed to give the policy of the CEO, and then we leave the CEO doing what he wants. Actually, the ERM is to have the boards going into details on all the departments of the company, and this is what we were doing in the past. And I believe that going back to this, probably our companies will make more profits.
Thank you. We have another question.
السلام عليكم.
عليكم السلام.
يمكن أن أتدخل أخوي. أنا صلاح بن عاشور من هيئة التأمين العامة بتونس. هناك شيء جلب انتباهي، هناك ملاحظة ليس سؤالا ولكن ملاحظة فيما يتعلق بالعنف السياسي وتأمين مخلفاته. فهي مشكلة كبيرة وعويصة وعويصة جدا، والإشكالية التي تطرح نفسها هل نؤمنه أم لا؟ وإذا أبت شركات تأمينه فسيتوجب على السلطات المسؤولة تحمل ذلك بما يستلزم، وخاصة وهو المتعارف عليه وهو إيجاد صناديق تعويض، علما وأن هذه الصناديق تكون في النهاية عبئا على كامل المجموعة الوطنية، لأن المواطنون هم الذين سيتحملون في النهاية العبء المادي لمخالفاته. مع الإشارة أن هذا العنف السياسي قد تولد عنه مشاكل عويصة لعديد الدول المتعرضة له، وانهيارات اقتصادية بالنظر خاصة إلى مخلفاته ونتائجه، مثلا على قطاعات حساسة مثل قطاع السياحة في تونس، علما وأن هكذا قطاع كان من أكبر مصادر العملة الصعبة، وبالتالي تغطية تكاليف الواردات هذه التي هي في أغلب الأحيان حيوية ولا يمكن الاستغناء عنها، فإن فقدها يؤدي إلى نقص ومخلفات عويصة. ولهذا أنا ملاحظة هذه في مخصص العنف السياسي أحد المتدخلين تعرض له وجلب انتباهي في مخصص تأمينه أم لا. وعادة شركات التأمين لا يمكن لها أن تتهرب مسؤوليتها، هي وجدت لتأمين المخاطر، وجودها مرتبط بوجود المخاطر، ولكن هناك في بعض الأحيان مخاطر قد تعجز شركات التأمين في حد ذاتها عن التصدي لها، مثل ما حصل، مثل ما يحصل عادة الزلازل أو الفيضانات، ومثلا نحن عندنا جدوز عندما تقع وقعت فيضانات أو في مخص مثلا وقعت في مخص السيسوريس تدخلت سلطات وقامت بتعويض المواطنين. ولهذا العنف السياسي هذا اللي هو من المتولدات الرديئة لهذا العصر، أكاد أقول الرديء أيضا، مشكلة عويصة جدا، خاصة معناها سواء كان مشكلة هي عويصة في حد ذاتها، سواء تحمل ذلك شركات التأمين أم الدولة، وكلها ستتحملها المجموعة الوطنية. السلام عليكم ورحمة الله.
وعليكم السلام. شكرا.
I will answer in English. Actually, we have the AURIS, the Arab War Risk Insurance Syndicate, where all insurance companies are participating, and they are providing terrorism cover. So this is something which already exists, but still the government, whether it is the Tunis government or another government, they will have, in my view, to declare whether there was a terrorist act or not.
جواب سؤال أستاذ. Any other question? Okay, then thank you very much. Thank you for our distinguished panel, and thank you for your time. Shukran.
Dear guests, we'd like to ask you to stay in the whole room until the last part of our session is over. We'd like to thank our distinguished speakers for moderating this panel discussion, and we'd like to ask Mr. Majid Smirad to deliver the honorable gifts to our speakers. Mr. Fadhel Sabea. Mr. Max Zaccar. Mr. Peter Englund. Mr. Hatem Ismail. I have a small announcement that Saraya Aqaba, where the dinner was held yesterday, welcomes you to join their team for a side tour. Buses will be waiting at Intercontinental today at 4 p.m. Our conference has come to an end. As the sessions have been covered for today, we'd like to thank all of the speakers and head of sessions that participated with their rich experience. Now we would love to invite you all to lunch hosted by Zain, the main telecom sponsor for this conference. With that being said, please join me in welcoming Mr. Ahmed Al-Hanande, Zain's CEO, to the stage.
مساء الخير جميعا واهلا وسهلا فيكم. بحب اشكر الاتحاد الاردني لشركات التامين والاتحاد العام العربي للتامين للسماح لنا بان نكون شريك معهم في هذا الحدث المهم في نسخته السادسه، واحنا بنكون معكم للمره الثانيه على التوالي. سعداء بتواجدنا معكم، سعداء بشراكتنا الاستراتيجيه مع هذا القطاع المهم بالاردن. الكل بيعرف انه قطاع الاتصالات وكافه القطاعات عم بتعيش حاله من التحول مع التطور التكنولوجي والثوره التكنولوجيه، ومهم جدا بالنسبه لنا وعلى سلم اولوياتنا التعاون مع قطاع التامين نحو تقديم خدمات افضل ودرجه وصول اعلى للمستفيدين من هذا القطاع المهم، والتزامنا بتوفير البنية التحتية والخدمات والقيمة المضافة اللي ممكن تساهم بتطوير هذا القطاع. To the very few who are still in the room, thank you very much for allowing us to be with you over the last few days. I wish that you had a great conference, and for those coming up from out Jordan, I wish that you had a great time in Jordan, and we would be looking forward to welcoming you again back into our beloved country, Jordan, and into our lovely city of Aqaba. Thank you very much.